We have discussed the unusually narrow breadth of the equity market in various discussions already in the Investor Insights series. To evidence this, many market commentators have referenced statistics comparing the returns of a market capitalisation-based index, i.e. where the percentage weightings of constituents are determined by the total market value of their shares, with that of an equal weighted index, where, as the name suggests, each constituent is given an equal allocation on periodic rebalancing. Indeed, to exemplify how unusual the recent period has been, if we look at rolling 5-year periods over the 20 years between 1999 and 2019, the equal-weighted S&P 500 index has only underperformed in 11%, or just 20 of the 180 rolling 5-year data points. Such was the persistency of the outperformance of smaller than average companies within the index, and the recycling and mean reversion of those largest companies in the US market over that period. However, over the subsequent 5.5 years, this trend has almost entirely reversed, with the equal weighted index outperforming in only 3%, or just 2 of the subsequent 68 5-year periods. However, with heightened volatility currently being experienced, and acutely so in the larger constituents of the US index over recent months, and a number of highly topical upcoming issues, including not least of all the US election and a potential change in trajectory of interest rate policy by the Fed, this was a timely juncture to catch up with Jonathan Tredgett, one of the portfolio managers on the hugely experienced and long-tenured team at Findlay Park. Welcome to the Investor Insights podcast, hosted by Killik Co. My name is Gordon Smith, and in each episode, I'll be interviewing portfolio managers from across the investment industry to gain from their expertise in the specialist areas in which they invest, and to question them on topical issues. You can access the full series of interviews via the playlist on the Killik Co YouTube channel, or by searching for Killik Co's Investor Insights on Spotify, where you can subscribe and be notified of future episodes. We hope you're enjoying the discussion so far, and you can get in contact with us about any of the topics discussed via the email address investorinsights@killik.com. Killik Co is an independently owned wealth manager which opened its first office in 1989 and provides services to help families save, plan, and invest. And you can find more details on the unique ways in which we do that at our website, killik.com. In this week's episode, we were joined by Jonathan Tredgett, who came to Findlay Park in 2011 and is a portfolio manager on the Findlay Park American Fund. Prior to joining Findlay Park, Jonathan was a portfolio manager and partner at Cheney Capital, and prior to that, between 1994 and 2006, worked on the US institutional equities desks at UBS and Morgan Stanley. Findlay Park is an independent investment partnership focused on a single mandate, the American Fund. The philosophy is to invest in a diversified portfolio of high-quality, durable US-listed businesses, and the approach used gives the portfolio a notable bias towards higher growth and more profitable businesses with higher cash returns and typically lower leverage than the average US-listed company. The team have a thorough investment checklist, stretching to around 30 questions, which the team run through in detail to thoroughly test the durability of each business model and help guard against downside risk. We discussed some of the key points raised by this investment checklist during our conversation, and this was a timely point to speak to Jonathan. We hope you enjoy the discussion. Please get in touch using the podcast email address if you'd like any further detail on any of the topics discussed. Jonathan, good afternoon. Thank you so much for joining us today. How are you doing?
Great. Thank you for having me.
So we've got this kind of standard opening question to these discussions that we've asked, I think, everyone on the series actually. And what its aim is to get a bit of an insight into kind of how you and the team work, or perhaps a project that you've been working on. I wondered if there was maybe an anecdote from a recent meeting, or perhaps an article or book you've recently read, anything that you could share with us?
Yeah, I was actually on holiday in early August, and I was doing a bit of reading. I read a few books. I reread Morgan Housel's The Psychology of Money, and I guess it's more of an idea than anything, but one of the ideas he touches on is how soft skills are underrated in our industry. And it struck a chord with me because my kids are always, my kids say, "Oh, my dad, he's in investing," and that you need to be good at math to do that. And Housel talks about this, saying that, finance is often taught as kind of a math-based subject and or discipline. And really, what he touches on in the book, which struck the chord, is it's really the soft skills or the qualitative aspects, the behavioral aspects of investing are more important. Certainly we would believe that here, and I think Housel touches on that in his book, versus the quantitative. But it's just interesting. I hear it from my kids. They think investing, they think you need a lot of quantitative skills. Some skills like knowing the compounding tables are probably very important to investing. But you also see it in our industry in terms of the development. I'm 53 now, and I've been, I guess, in the finance industry for about 30 years. But you see more and more with algorithmic trading and with high frequency trading, and all the data that's produced. There's a lot more number crunching and a lot more quantitative aspect. But we need to keep our eye on the fact that the qualitative aspect and the behavior aspect is very important in our industry.
Absolutely. Yeah, art and a science, I think. So and 100% agree with that book recommendation. Worth a read and a reread, I think. Jonathan, we're recording this at the end of August, and it's been quite a roller coaster the last couple of months, really. But I mean, kind of aside from that, perhaps shorter term noise and the kind of fluctuations that we've seen, it remains very much the kind of feature of recent market returns has been that kind of narrow breadth, and we've discussed with other speakers about this kind of topic as well. But that kind of small group of mega cap or very large stocks leading the market higher, and against that backdrop, we've heard or seen in your commentary the talk of that kind of evolution of the funds, kind of increasingly looking at mid caps within your universe. So I wondered if you wouldn't mind kind of talking us through that evolution that you're kind of discussing there and the rationale behind that.
Absolutely. And maybe, as you point out, it has been a pretty unusual environment, the narrowness of the market. I think in the last 12 months, at least to the end of July, I think about half the performance of the S&P has come from 7 companies. And Q2 was quite extreme in that regard, with more than 100% coming from 7 companies. So, yeah, in terms of us focusing more on mid-cap companies, and just to define our terms, we define mid-caps as companies with market caps between 3 and 50 billion. So the higher end of that would be very large in a global equity context, but in the U.S., that's not a big company. With you got 2/3 of the S&P 500 is over 100 billion market cap. So I would say, just zooming out a moment in terms of, because this evolution in terms of us owning more mid caps, about 75% of the holdings in the fund, the new holdings in the last 3 years have been in that market cap cohort. If you just zoom out, it's pretty consistent with the history of the fund. The fund started, as I believe 26 years ago in 1998 as a small cap fund. And at that time, the market was also very narrow, right? This was the late 90s. The TMT bubble was kind of building up at that time. And then you roll forward after the first 10 years of the fund's life, and you get to kind of the late 2000s and 2010, small mid-cap stocks had done incredibly well. And it was at that point where the fund could have, the managers could have continued to have bought overvalued smaller mid-cap companies, or they could have moved into moving up the market cap curve, taking the same investment philosophy, but just applying it to larger companies. And that's what the fund did. And that's when the fund started to own larger companies and became an all-cap fund, which is what we are today. And we're very happy we did that. If you look back at the compounding tracker of the fund, it would have been worse if we didn't do that. If you look at where we are today, the circumstances have changed a lot, though. If you go back 10 to 15 years ago, mid-cap companies were trading at about a 10% premium to large caps. Today, they're at about a 20% discount. So the valuation is looking much more attractive for mid-cap companies today versus large caps. So that's one driver. The second driver is we do think the investment environment's changed a lot. If you look at the last decade, a lot of that period interest rates were zero, which was very favorable to large growth companies. We're now in an environment where we've had higher inflation, higher interest rates, and then you have this deglobalization trend, and you're seeing a lot more push by governments to reshore localized production. And we think this reshoring or nearshoring trend is going to be much more favorable for companies that are smaller or mid-sized that haven't built out their global supply chains to the same extent. And I guess the final reason I'd leave you with is, we do think, given we're in a much different environment for investing, we think a different cohort of companies are going to perform in the next decade. So we think that the market's performance is going to broaden out from this small group of companies. And I guess the proof of that is if you look at, over the very long term, the equal weighted S&P tends to perform in line with the market cap weighted. Over the life of Findlay Park, the last 26 years, they're identical. And yet in the last 5 years, the market cap, the S&P 500 has built about a 30% cumulative performance advantage versus the equal weight. So we think that's an anomaly, and we think it will revert. The timing is hard to tell when.
We may well have listeners that have gone through that evolution, right, from smaller companies into larger, and now slightly back again. Yeah, for sure. And you're absolutely right. We've made that point on previous episodes. It has been an unusual period in the context of history, with large cap outperforming so significantly and so persistently, really. So that makes sense. Jonathan, we perhaps can't not talk about the US election as we get kind of ever closer to that vote. And I appreciate there's lots of changing paths to this at the moment, not least of all kind of changes in candidates or polling data. But I was interested in some of your recent commentary that the team did. I think a section of which was titled, "Does it matter who the American president is?" And I appreciate that might have been a slightly rhetorical question, but could you maybe talk us through your thoughts around the election impact and kind of how you're navigating the portfolio as we approach that date?
Sure. So the fund's invested through 6 election cycles. And I think one of the, philosophically, one of the things we're trying to do is we're trying to, hold a portfolio we can live with in any environment, because we might get it. And that applies to elections as well. So I guess the punchline, and then I'll get on to, does it matter who the American president is? The punchline is, America is going to remain a great place to invest, in our view, irrespective of who's in the White House, due to a whole bunch of, qualitative, entrepreneurial, growth-driven. They have the right regulatory and political structure, deep capital markets, energy self-sufficient. All these factors are going to remain in place no matter who's in the White House. Now, to kind of the somewhat rhetorical question of, does it matter who the U.S. president is? We're not sure it does. And the reason why we touched on this is it's really the checks and balances of the U.S. political system. The checks and balances between the executive branch, president, the legislative branch, Congress, and the judiciary. So, the president can veto bills, but then can be overrode by a 2/3 majority of Congress. Congress can pass laws, but then the judiciary can say that's unconstitutional. And you've seen a lot of this in recent years where the courts has actually come in and curbed the power of a lot of federal agencies. So it's very hard to see kind of unilaterally, even with a single party controlling Congress, that they can unilaterally push entirely the agenda they want. So what you end up getting in the U.S. political system, because of these checks and balances, is there's policy progress happens where they both agree. And you've seen that in the last 2 presidential cycles. Trump effectively came in on a landslide, controlled Congress, and he really just got the tax, his tax reform, tax cuts done. And then when Biden came in, also controlled Congress, and really got only one piece of legislation passed, the IRA, the Inflation Reduction Act, which the Republicans were non-supportive. So you tend to get progress on where they both agree. So we would expect where you might continue to see progress is trade, putting up tariffs, because they both agree there, and kind of China, being the competition with China. So that's one area where I think you'll see progress. And reshoring is the other. So this idea of reshoring jobs or localizing production is an area. And one thing which is not a policy, but it's kind of an output, is I think you're likely to see higher deficits because neither party seems to want to stop spending money.
That point on deglobalisation or reshoring, I think you've mentioned it in 2 answers already in kind of passing. It is such a kind of a powerful theme at the moment. I wondered if we could maybe explore that a bit deeper. And is it still a theme which you're kind of directly playing in the portfolio? Could you kind of talk us through how you invest with that in mind?
Yeah, so we're not thematic investors, just to be clear. We're not thematic investors, but we do have a few. Look, for us to identify something as a theme, it has to be kind of long lasting, not really that controversial. So the digitization of businesses, is one of our themes, and that's, I don't think, a controversial. And we do believe deglobalization is a theme, and different people have different opinions of how much will actually be reshored or friendshored or nearshored, whatever terminology. But it is something that it's bipartisan. It's long lasting when you look at the legislative package. It's diversified from a way to play. So for us, we like diversification in the sense that we don't want to play one type of company or one type of business model in one sector. So there are many ways to play it, and there are hard incentives that are driving it. The U.S. has kind of done a carrot and a stick approach. The carrot is the tax incentives and this big legislative package that they've put out, which we could touch on. And then the stick is the tariffs. So if you're making something abroad, they're going to make it more expensive, and they're going to try and incentivize you in that way. So they've really taken a carrot and a stick approach. So there's hard incentives attached to it. So there's been a large legislative package. The three big ones that people talk about is the Infrastructure Investment and Jobs Act, which is really improving America's infrastructure. There's the Inflation Reduction Act, which is a bit of a bizarre name. It's really a decarbonization legislation, effectively. And then there's the CHIPS Act, the idea of let's make more of our semiconductors in the United States, because they've outsourced a lot of that manufacturing to China and to Taiwan in the last 25 years. So we do have multiple businesses that are leveraged to that trend. So a few examples: we own Martin Marietta, which is one of the largest aggregates companies in the U.S. We also own CRH, which is another one of the largest aggregates companies, and they will both benefit from all the infrastructure and spending on improving roads and highway spending, there's a material uptick there that's just starting to come through now. Another example would be we own both Canadian railroads, so Canadian Pacific, Kansas City, and Canadian National. And we think as more intermediate goods are made in North America, Canada is a big commodity economy, and Mexico is a big manufacturing base to export to the U.S. Those railroads both have networks that touch all three coasts, Canada, and they go through the U.S. and into Mexico. So they will play an important role, or important kind of transportation artery in benefiting if you get more manufacturing activity within North America.
Jonathan, just to touch on that theme, that kind of trend in a bit more detail. I guess it works both ways as well, in terms of kind of, you talked about tariffs with China. You maybe talk about that kind of exposure within the portfolio to the exporters versus the kind of domestic consumption. How are you kind of thinking about that? Have you kind of made any changes there?
So we have slightly more exposure. If you compare this, for example, to a benchmark, like to a widely held benchmark in the US, like the S&P 500, our own benchmark, which is the Russell 1000, we would have slightly more domestic revenue exposure. So about 65 to 70% of the revenue of our companies would be in the United States. So slightly more domestic. But as I mentioned, one of the things we like about this, this legislative package and the kind of the reshoring trend or localizing production is it doesn't only benefit domestic companies. So I wouldn't want to give you the impression that we are searching purely for domestic manufacturing business. That is not at all the case. So, and I'll give you one example. So we own Texas Instruments, which is very much the largest analog semiconductor company in the world, very much a global company. Does have plants in other parts of the world versus the U.S., but it's very much a global company. But because of the CHIPS Act's tax incentives, for every dollar of production capex they put in the United States, they get a 25-cent tax rebate. So we are a slightly more domestic portfolio than the benchmarks, but there are multiple ways to play. The beneficiaries of this legislation are not just domestic companies, but it's more skewed to domestic companies.
Yeah, no, really important point. Yeah, thank you for that. My next question is regarding the inflation and interest rate backdrop. Inflation in the US has proved a little bit stickier than expected so far this year, certainly relative to kind of consensus expectations coming into the start of the year. And although we are kind of starting to see a kind of clearer sign from the Fed moving towards that first rate cut, it's clear that we are in a kind of different economic environment to that which markets got so used to just a couple of years ago. I mean, if we were to kind of flick through some of the presentations that you've given us over the years, one of the kind of key parts of that investment checklist, I think perhaps I've heard you say it's the very first question on the list is related to whether a business has pricing power. And obviously that's always a critical consideration, but particularly so in an inflationary environment. Could I maybe ask you to talk us through that point, and maybe also, is there an example or two of businesses which you view as screening particularly well on those factors?
Yes, pricing power, I think, is in our view, it is one of the most important attributes that a business can possess. And I guess just to define our terms, like what is pricing power? Because to us, if you take your prices up 1% to 2% a year, that's not necessarily pricing power. If your costs are going up more, that's going to lead to your margins contracting, and you're not going to be able to invest in R&D and sales and marketing to expand and hopefully grow your business and your market share. So we are thinking, pricing greater than your cost inflation. So real pricing is really important. And to be clear, when inflation jumps up like it did in recent years, it's not that every company can all of a sudden reprice their entire business within a year, but it's the ability over time, in a reasonable amount of time, to recapture, inflating costs with pricing. So I'd say that's one. And then one other metric from how we think about pricing power is, can you raise prices without losing volume? There's any business can raise price, but many of them will lose volume, or their competitive position will deteriorate. So when we're talking about pricing power, very important, but those are some of the ways that we think about it. Examples, I'll give you two examples. One, a company like Sherwin-Williams, that saw a big increase in its cost because Sherwin-Williams, which is the largest coatings company in the world, so paints and coatings, they saw a very large increase in their cost of goods sold, and about 80% of their cost basket would be tied to oil or tied to resins. So when oil prices went up a lot as we kind of came out of COVID, they had to recoup that through higher pricing, which they've done. So they have the ability to do that. There's probably no better, looking long term, there's no better example of that. If you look at, you go back to the global financial crisis, right? And what happened to their business since the global financial crisis? Because you had a huge boom in the volume of paint during the global financial crisis. And if you look in the last kind of 17 years, volumes have only grown by a very small amount for the company because it was coming off such a peak. But the earnings per share of Sherwin-Williams is about 5 times, it's 500% higher than it was back in 2006. And a lot of that is the pricing power in the business because it has not been volumetric-based growth. It's been the pricing power they have. So that would be a good example. And I'll throw one more out, which would be Martin Marietta, the aggregates company. Same thing. It's a company like Sherwin where they're selling a product that's a very small part of the end bill of materials for their customers. So aggregates in a construction project, usually less than 5% of the cost, just as paint is, like for Sherwin-Williams, is usually less than 2% of the cost. So when they raise prices, it's not as arduous for their customer because it's such a small amount of their cost base. And Martin Marietta, the same thing. If you go back to the global financial crisis when there was a big bubble in volumes have barely grown for them over the last 15, 16 years. And yet their earnings per share is about 4 times higher because of the consistent ability to price their business above the cost of inflation.
Jonathan, this is time for a couple more questions, if I may. There's one I wanted to ask you about the US consumer. I mean, obviously we went through that kind of July period where there was that kind of shock of, has the Fed kind of left it too long, and what will be the impact on the kind of US consumer and the US economy? I just wondered if I could ask you to talk through how you think about the kind of direct consumer exposure within the portfolio. I know you've written about that in a lot of your recent commentary as well.
Yeah, so it's interesting. We when you think about consumer exposure, so the fund has never owned a lot of consumer staples, which is one thing that stands out. When we talk to clients, they're like, well, you are interested in owning quality companies with high returns on capital. Why don't you own staples? And we've historically, staples tend to grow a little bit slower than most of the companies, in the fund, firstly. Secondly, they are quite exposed to changing consumer preferences, whether it's health and wellness or other, but we found a lot of those companies have had to adjust their business to the health and wellness trends. They tend to be paying quite high multiples for the companies that are in the health and wellness area. So it's the changing consumer preferences. And so those are the two of the big ones. And then the third reason for staples, at least, why we haven't owned a lot of them historically, is the distribution points for staples have become narrower and narrower because of the success of big box retailers like Walmart, Costco, Target, and even the consolidation within grocers. So it's meant that you have companies like Kellogg's or Campbell's that are getting 25% of their sales from one customer, Walmart, which has kind of eroded their pricing power, which we talked about earlier. So we haven't owned a lot of consumer staples. Where we have had exposure is in areas of consumer discretionary. So they might have a slightly higher cyclical element, but they still have high returns on capital and are quite inevitable and essential businesses. So we own companies. We own Formula One, for example. We own Live Nation, which is the largest concert promoter. We own Airbnb. So we found companies, Hilton, which is the licensor or franchises hotels. So we've owned companies in these areas with a slightly more consumer discretionary bent, but they're leveraged into travel or live events, which is areas which, again, have disproportionate pricing power and actually have been surprisingly resilient through different economic environments and tend to grow faster than some areas within consumer.
Yeah, no, that's really helpful. Really interesting hearing you talk about kind of selections within those two segments. We've got a standard final question to these discussions as well. And it asks the speaker to highlight one area or stock within the investment universe that you have a particularly high conviction in at the moment. I wondered, you've mentioned a few areas already, but I wondered if I could push you to pick one more that you might highlight to kind of answer that.
Sure. So I guess we own 56 companies, so it's like trying to pick your favorite favorite child. I guess I would probably pick Accenture right now, and the reason why is, it's a great business, firstly. So but I'll get on to why tactically would I pick it out versus the other 55 I could have selected. It's a great business. There's a great brand name, a good culture, diversified client base. It's a high return on capital business, very high free cash flow conversion, has no debt. And currently it's trading, just over 20 times free cash flow per share. So we think the valuation looks attractive. Now, why? The shares are slightly down year to date. And I think what the opportunity is here is you've seen a very big divergence within technology in the US market between, AI haves, we'll call them AI haves and have-nots. And the haves are anything that's an immediate beneficiary that's making or designing chips. We happen to own NVIDIA, and we own KLA Tencor, which actually provides inspection equipment for chips. We own Microsoft, but everything that is a kind of an AI have has been bid up and has done incredibly well. And then anything that is perceived to be a have-not, and we certainly do not think Accenture is a have-not, but where the immediate benefits are less obvious, those stocks have just been left for dead. And I would put Accenture in that bucket. And yet Accenture, interestingly, when we go around and we ask all of our companies about AI, the one thing they all say is that those that are not able to deploy AI or generative AI internally right now, the number one reason is that their technology stack or their IT systems are not ready to actually ingest it, so to speak. And they need to clean the data. And this is an area where we think Accenture is going to be helping a lot of companies. There's going to be a lot of companies looking for advice. And of course, they're a big IT services company, but they also have a consultancy and an advisory big business. We think a lot of companies are going to be going to Accenture looking for advice. And we view them as kind of a nice agnostic kind of picks and shovels supplier of IT services to companies. And whenever you get paradigm changes in technology, it tends to be very good for them because people are looking for advice. And I'll give you an example. Accenture, if you went back 25 years ago, was big at doing ERP implementations, like SAP implementations at company. And when the cloud came along, 15 years ago, people thought, Accenture's business is going to do very poor because we're not going to need everything's going to the cloud. There's nothing's going to be on premise anymore. And, they have a $32 billion cloud business today. So the conclusion is these types of technology changes are actually very good for their business. So we think we think the market is kind of misreading that, and we think that's an opportunity.
Yeah, absolutely. It does certainly seem there's lots of companies that realize that AI can help, but it's working out how exactly best it can help. Certainly seems that Accenture's in the right place to help with that. No, for sure, and a good example. And Jonathan, as always, really interesting to talk to you and the team. I really appreciate you sparing some time. Thank you.
My pleasure. Thanks for having me.
Thank you for listening to the Investor Insights podcast, hosted by Killik Co. You can get in contact using our podcast email address, investorinsights@killik.com, for more information on any of the topics discussed, or for further details on the services offered by Killik Co. This podcast is not personal advice. The content is intended for educational purposes only and is not investment research or a recommendation to buy or sell any financial instrument or product, or to adopt any investment strategy. The value of your investments can rise as well as fall, and you could get back less than you invested. Past performance is not a guide to future performance. The investments referred to in this podcast may not be suitable for all investors, and you should seek advice from a qualified investment advisor. Killik Co is authorised and regulated by the Financial Conduct Authority, the FCA.